In this week's video, we'll review the latest charts and numerous historical cases to help us answer the question, how likely is a V-bottom in the stock market? It's a daily chart of the S&P 500 ETF SPY during Friday's trading session. The S&P 500 itself during the day was up 24 points and down 3 points for the week. We have the impressive V move here. What once acted as support may now act as resistance on the first pass. We did not clear this. Looks like the market wants to test this line here and this downward sloping trend line here. We'll learn something either way. The next guidepost would be a flattish red 200-day moving average, and then the trend line that connects the highs from October, early November, late November, early December in here. We're also contending with RSI resistance price. RSI comes up here, resistance. It would be impressive if we can get to the other side and hold that. That's still to be determined. We can also learn something looking at SPY stocks relative to IEF bonds and running that through the trend strength portion of the model. You can see the trend in SPY relative to IEF has a lot of work to do. It really hasn't made much progress yet. Similar situation with the NYSE composite daily during Friday's session. A little bit more constructive look on RSI, but we've got an arbitrarily drawn trend line here. So we'll learn something either way. This is an impressive move here. Support, 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 support. Acted as resistance for a few days and we blew right through it. During Friday's session, we're testing now the downward sloping trend line that connects this high and this high. And the November-December high runs right into a downward sloping 200-day moving average. It would be impressive if the market can clear the 200-day and then consolidate above it or run above it. That's all to be determined. During Friday's session, the number one ranked equity-related ETF based on the results of the CCM ETF scoring system and stack rank is Brazil. Unlike the S&P 500, Brazil, from a short and intermediate term perspective, time frames that matter, has a very strong trend and scores well at this point. However, it does have some hurdles to overcome. Resistance in 2008, resistance in 2011, you can see probably going to test the downward sloping blue trend line. Resistance in 2013, resistance in 2014, again in the same general area in 2018. And like the other charts that we've reviewed, we'll learn something either way here. Obviously, this could be somewhat of an inverse head and shoulders pattern. If we can clear the neckline and this blue line, it's possible we could run a long way in this direction. Daily RSI is looking a little bit tepid here. Price is way down here. RSI is way up here. Now price is way up here and RSI is lower. But it's possible with a breakout here that this could correct itself. From a long-term perspective, not a particularly attractive risk-reward entry point for EWZ for us. Because as you can see, at these prior points of resistance, after price was rejected, really bad things happened. That's not a prediction. The strong trend of EWZ tells us to keep an open mind about EWZ moving in this direction. And if that's the case, then we would probably learn something about the chart of SPY. You can make an argument that we could be forming a similar pattern, with this being the left shoulder, the V bottom being the head, and we could come up and form potentially a right shoulder here. If that's the case, we would move above the 200-day moving average and make a run all the way up to this trend line here. Update on the Fed front. Remember, in December, we expected the Fed to walk back in a serious manner their hawkish tone. We expected that based on the last 20 some odd years of how the Fed interacted with the financial markets. It didn't happen. The market didn't like it at all and for the most part crashed. As we expected in late December, now they're walking back those comments. Remember in December when we talked about quantitative tightening, Chairman Powell, Fed press conference late December, we're in the middle of the worst December in stock market history, and he says we came to the decision that we would have the balance sheet runoff on automatic pilot and use rate policy as the active tool of monetary policy. And he closed with, I don't see us changing that. Well, obviously the market did not like that stance, and if we fast forward to Friday's session, despite the fact that he said on December 19th, I don't see us changing that, they're already changing their tone on that topic. This is a potential positive for the markets going forward. Before we get to the charts, let's talk a little bit about the bird strike analogy and how it can help us in the financial markets going forward. From a flight safety specialist, losing one engine is not going to cause an aircraft to crash because they are designed to fly with one engine down. However, multiple bird strikes or hitting large birds can and have caused serious accidents. From an ABC News article dated January 15, 2009, which was the day that the U.S. Airways jet made an emergency landing in the icy Hudson River. Birds fly into airplanes every day, and most do so without causing major damage. It usually doesn't even register as turbulence. But bird strikes can be deadly, with more than 200 people killed since 1988 because of airborne collisions with birds, according to Ostrom's committee. As far as the analogy with the financial markets, we're not putting together a CCM everyday bird strike manual. We're putting together the CCM bird strike crisis manual. And while it is true that birds fly into airplanes every day, in rare instances they can and have caused serious accidents, and in rare instances bird strikes have been deadly. From an everyday bird strike perspective, the look of the S&P 500's chart on October 3rd, 2018 did not scream imminent plunge. Remember, we noted since World War II, only in 1 year, 1990, did the markets have two 10% plus corrections. Based on that one stat, there was roughly a 98% chance that any pullback from this level here would have been less than 10%, most likely somewhere in the 3 to 6% range based on what we knew at this time. And in more typical circumstances, this would have been somewhat of an everyday bird strike. If I had some type of relatively shallow pullback here, that would have been no big deal. But once again, we're not concerned about the everyday bird strikes. We're concerned about the lower, very low probability events, a confluence of events that can and have caused serious accidents. Another real-world example in the stock market that we covered at face value here on October 14th, 1987, 3 trading days before Black Monday. The first thing that probably jumps off the page here, slope of the 200-day moving average. Very, very strong. This is a strong trend. Price has been well above it. This moving average cluster here looks strong as well. And at face value, without picking things apart in a very, very detailed manner, the market's longer-term profile here, 1 trading day before Black Monday, if we were in a everyday bird strike mindset, probably wouldn't have prepared us for the 20% crash that occurred the following trading day. Now let's shift back to the headline topic of this week's video, which is, what is the probability that this V bottom look here, this is the S&P 500's chart as of January 17th, 2019, will hold and stocks will just continue the V and move in this direction? When we were going through the bird strike cases, we noticed it's relatively rare to see the simple 100-day moving average in blue cross below the 200-day moving average in red. And more specifically, in an instance where the 200-day moving average either has a flattish or negative bias to its slope. There were 2 or 3 cases where this occurred, where the slope of the 200-day was incredibly strong, and we threw them out because that's not what we have in the present day. So from a comparison perspective, we know that this cross occurred on January 17th, 2019. Going back to the end of World War II, we had a similar cross that occurred here in June of 1953. Here's the cross. And another one occurred in December of 1956. So all of the charts that follow were put together in a similar manner. Historically, we know the day of the cross here. We can also figure out the day of the subsequent low after the cross. You can see the cross here. We can record that. This is the subsequent low that occurred on February 12th, 1957. And we can calculate the decline between this date here and this date here. Between where the S&P 500 was on this date here and the low that followed here. That'll help us get some idea of how often does something like this happen, where we get the bearish cross and the low is already in and the stock market continues a V and moves in this direction. So let's look at the rest of the historical cases and see what we can find. We'll move through these relatively quickly and then double back and look at some hard data to help us answer those questions. Similar situation, 1957, 1960, 1962, 1966. In chronological order, here's our cross here. This is the similar period here in 1968, similar period here in 69, 71, and 1973. This point here is similar to this point here in 1977, and similar to this point here in 1981, 1984 on the upper right portion of your screen, and 1987 in the lower right. Similar situation, 1990, 1994, the year 2000, 2007. In the last 3 cases, 2010, 2011, and 2015. Thus, once again, we know that the similar cross occurred recently on January 17th, 2019. If we figure out the day of the cross, where the S&P 500 was on the day of the cross, and then where it was at the subsequent low or at the subsequent retest, or if there even was one, it'll give us some idea of the probabilities relative to this waning long-term trend profile here. These are the 21 cases that we just looked at. In 95% of the cases, the stock market moved lower from the day of the cross, and in roughly 81% of the cases from the day of the cross, which is similar to January 17th of this year, there was a significant retracement, retest, or lower low that was made. If we look at all 21 cases, the average number of days to the retracement low, a retest low, or a lower low was 169 calendar days. And as we know, in these instances, the median move is probably more helpful the median number of days from the time of the cross to the subsequent low was 81 calendar days. The average decline, so that would be the day of the cross, where the S&P 500 was. In the average case, from this point here, hypothetically, we would fall 14.85%. And if we look at the median drop from this similar point here, it was 11.51%. Out of these 21 cases, there's really only one case, 1987, where the stock market never looked back. The low was made 3 days in the rearview mirror relative to this cross, and we moved higher. Now let's look at each case in a little bit more detail and point out some things that could be helpful. So once again, what the table is calculating, this is the day of the cross in 1957. We can record where the S&P 500 was, figure out how many days it took to get to this retest low, and what the move was from the day of the cross to the retest low. In the 1957 case, we get a bottoming process, a low, a rally, and a retest. And we know from prior videos that a retest can be a higher low relative to the original low. We can come down roughly to that level, or we can exceed it. In the 1960 case, here's the cross, made a lower low here after the initial low. 1962 case, here's where the S&P 500 was. We make a low and then a lower low. 1966 case, we rally and then make a low and then retest that low. And in this case, the retest is a lower low. 1968, from the day of the cross, we have a rally and then a higher low retest, but there is give back. In this case, the market makes a discernible lower low relative to the first low, discernible lower low relative to the first low. And this point here, January 17th, 2019, is similar to this point here in the 1973 bear market, where really bad things happened for a long period of time. Similar situation, 1977. This is similar to this. We're a long, long way from the bottom, despite this rally here. 1981, it leads to a bear market. 1984, we get what looks to be a significant rally almost all the way back to a downward sloping 200-day. It fails and we make a much lower low and then even really retest that low. 1987 is the one case. This is the lowest closing low in early December. The cross actually comes 3 days after that. But we've covered 1987 in the past, and we get somewhat of a creeping consolidation and rising trend look. It's far from a V-bottom. The 1990 case really doesn't mesh up all that well. You get a cross that's very, very indecisive here. The market makes a bottom and then rallies above the 200-day, above the 100-day, and that move is painfully retraced. Notice the flattish and indecisive look to price and the moving averages here. So it is possible in the present day we could see something similar. We could rally above the 100 and the 200 and then fail. Maximum flexibility. 1994, similar to the present day, the market's rallying. It's coming off of the low when the cross occurs. In this case, we rally all the way back to a flattish 200-day moving average, flattish to up in this case, which is similar to what we have in the present day, somewhat of a flattish look here. And in this case, we fail at the 200-day and have a significant retracement that almost goes all the way back to the original low that was made roughly 3 months prior. This point here looks similar to this point here in the year 2000. And in this case, we get big 100% normal and to be expected counter trend rallies within the context of an ongoing downtrend in what turns out to be a devastating 50% plus loss bear market. Everything that we just said about this point here and this point here applies to this point here in the year 2007. The 2010 case really doesn't look anything like the present day. Guess you could make an argument that we're coming off the low here and the cross comes after this low. But in this case, price comes up to the 200-day and then fails at a downward sloping 100-day moving average. In the present day, we are still below the 100-day moving average. After that, a significant retracement and give back that comes back almost all the way to the original low that was made in July of 2010. 2011 is similar. You're rising off of the low when the cross occurs. You get consolidation, a retest, and in this case, it's a lower low relative to the original low. There's a lot of lessons here about being patient in the 2015 case. The low is in here. We're moving back toward the moving averages and we get the cross. You can make an argument that's similar to the present day. In this case, we get a strong move off of this low. We blow through the 100-day, slice through a flattish 200-day. So imagine what it would have felt like right here. And then, with a negative slope, a negative to flattish slope, this rally fails miserably and we exceed the original low and make a lower low, reminding us that even if the market continues to rally in the present day and blows through all of the moving averages and gets above the 200, and even if the 200 starts to turn up, we still have to take it day by day and respect the fact that in the present day, this is a waning trend look. My 100-day trend is now dropping below my 200-day trend. Price is below both moving averages, and the slopes of the moving averages are at best flattish and at worst trending down. So this is all the hard data from the cases that we just reviewed, and it might be better to look at the median and average cases on a graph like this. The moral of the story is, from January 24th here, if we drop down to the median case or the average case, the market would fall from this point A eventually to this point B, or from this point A in the average case down to this point C. And coincidentally, that's an area of logical and possible support here, and logical and possible support here in this area of consolidation, in this area of consolidation. And as always, it's extremely important to note, this is absolutely, positively not a forecast about what we anticipate happening going forward in 2019. We're just trying to better understand what this means. Look at this chart here. This is July of 2016. Does this look anything like any of this? Here, for the most part, we have price above an upward sloping 100-day moving average. The 100-day moving average is clearly above an upward sloping and bullish bias 200-day moving average in red. This would be a full-bore bullish look here, with price above both moving averages and the slopes of the moving averages are up. It's almost the polar opposite of what we have over here. Now, for the most part, we have price below both moving averages and the slopes of both moving averages are either down or the bias is for them to roll over. The probabilities are much more favorable here than they are here. And we know that probabilities are much, much different than certainties. And in the past few weeks, we've shown numerous cases where the market likes to try to fill the easy white space after a plunge. And if you study historical cases, often this oversold rally comes back to the original plunge area, which would be roughly where we are on January 24th. In other cases, you come all the way back to the original plunge area, which is closer to 2,800. And in numerous historical cases, you rally all the way back to the red 200-day moving average, which is sitting roughly at 2,750. In recent videos, we've been talking about taking a prudent, measured, and data-based approach to the markets. And we always talk about having a flexible, unbiased, and open mind. And we have a lot of hard data in hand that should help us do that. The 21 historical cases that we've covered in this video unquestionably tell us to keep an open mind about A, a significant retrace of the move off of the Christmas Eve low, B, a lower low being made below the December low, and C, in some cases, a devastating bear market. From the day of the cross here, which would be similar to January 17th, there's a lot of negative signs here in this table. But if you've had a chance to see the post on short takes dated January 21st, covering a recent rare 10-day AD breath thrust, you know that the breath thrust that took place between late December and early January of this year, at least from a historical perspective, unequivocally leans bullish, helping us keep an open mind about better than expected outcomes in the days, weeks, and months ahead. But we should also keep in mind, in terms of the breath thrust, as noted in this table here, relative to the historical cases, it's extremely rare to get a breath thrust off of a V-bottom type low. And you may remember when we reviewed all of the thrust cases, the case that seemed to check the most boxes relative to being similar to the thrust that ended on January 8th, 2019, was the 1962 case. Thus, it's helpful to know what happened in the 1962 case. Did we actually get a V-bottom, and did we blow through all of the moving averages? The answer is no in the 1962 case. This is the A to B move off of the low, so this would be what appears to be a V-bottom off of the low in 1962. And then over 61.8% of that V-looking move off the low was retraced over roughly a 60-day period. So there was a 60-day give-back period that took a big chunk out of the original V move. What happens in 2019 is obviously to be determined. Is it possible that we're going to get a V-bottom in 2019? We know the answer. It's absolutely positively yes, it's possible. But as the 1962 breath thrust case and all of the similar cases with the bear cross of the 100-day below the 200-day tell us, we should also be open to a significant retracement and/or new lows exceeding the low that was made in December of 2018. It should also be noted the breath thrust occurred over a 10 trading day period. The information captured in the 100 and 200 day simple moving averages gives us information relative to the net aggregate opinion of all market participants over the last 200 trading days. And that by no means is meant to discount the potential importance or relevance of the breadth thrust. We believe that breadth thrust should be taken seriously, and we are taking it seriously. With the market having a strong session intraday on Friday, it's an excellent time to update our bull-bear charts that we've been covering over the past 2 weeks. In early January on short takes, we said it wouldn't be surprising to see an oversold rally come back to the 2600 to 2670 area. We're basically there. When we were up 26 points during Friday's session, we were just a hair under 2670 at 2668. We've been rallying for 4 weeks, and thus far, no sign of any retest. This retest occurred 5 to 6 weeks after the initial low. This one 7 weeks. This one 4 weeks. In the 1998 case, it was 5 weeks. As we noted last week, the concept of a retest really doesn't impact what we're doing in any shape, form, or fashion since we are data-driven. And you can see the slopes of our moving averages here and the stock market's progress not really materially different from where we were here. It would be much, much more constructive if we could get a look like this, or this in the coming days and weeks. And given these downward sloping trend lines here, that still falls in the to be determined category. And it would be even more impressive if we could blow through the orange 200-day moving average on the first attempt. If we look at the moving averages during Friday's session on the 25th of January, it's still very, very difficult to say we've really proven a whole lot. The 2001 case, we have a V-type bottom. We come up into the same moving average cluster and really can't gain any traction. 2008, later in the bear market, this is much weaker here. The case in the upper right-hand corner seems to correlate better with 2019. In this case, we came into the moving average cluster, moved all the way back to the downward sloping and orange 200-day moving average and failed. The good news is the 200-day moving average in the present day is sitting under 2750. So we should learn something either way. Similar situation in the 2015 case. We came into the cluster, made it to the other side in this case, and then failed. These were the boxes that we covered 11 trading days after the low. This chart's dated January 10th. If we fast forward to Friday, January 25th, intraday with the S&P up almost 27 points, you can see we blew right through both of the boxes here in an impressive manner. And now we're approaching the green downward sloping trend line. This is off of the high here. Off of the high here. Similar trend line in 1987 acted as resistance. After a few weeks, it was eventually cleared. A trend line off of these highs here did slow down this move off the low, and we got somewhat of a significant retracement here and eventually moved higher. Similar situation in the 1998 case. Trend line off the original high had a false breakout and eventually a retest that resulted in a lower low. And in 2016, it basically slowed the move off of this low here, and we had a messy up and down move above and below the downward sloping green trend line. In all 4 of these bullish cases here, even though the market eventually moved substantially higher, a trend line in each case slowed the advance in some way. That may or may not happen in the present day. We'll learn something very, very soon on that front. Just quickly updating some of our visuals. Constructive period to be in the market here, big move. This is what our profile looks like here. This is what it looks like during Friday's session. If we move higher, we would expect to see this start to morph into something like this relatively soon. Similar situation, profile here, constructive, really good things happened. Profile, same moving averages during Friday's session. And it's still within the realm of reason that we could move above all of the moving averages, including the 200-day, and then have some type of significant retracement, as we did in 2011, and then eventually we could push to higher highs. This type of movement here gives the data time to catch up. Here's our V bottom look in 2001. This is October 26th. So that would be roughly in this area here. These are the same moving averages and the same similar look on January 25th. Not a prediction, simply an observation. You can see in this case the 200-day in orange acted as resistance. We're approaching that 200-day. It also acted as resistance in 2008. In this case, the 200-day is in red. If we come down and have some type of retracement, as we did in the 1998 case, it typically forms a more sustainable base to move higher from. Can good things happen when we have a concerning profile? The answer is absolutely, positively yes. Similar concerning profile here in February of 2016. Here, we did end up making a lower low, but that was followed by very, very satisfying gains and a much more constructive profile here from a risk-reward perspective. So in terms of keeping an open mind about better than expected outcomes, this profile here on February 4th, which is roughly a week before this low was made, doesn't look significantly different from our profile on January 25th. Just as a reminder, if this acts as resistance and we move lower, and if we end up being in a longer-term bear market, and that is to be determined, the way we feel here in the present day is not substantially different from the way human beings felt during this 2-month rally here. A rally that we know was painfully retraced. The way we feel here is not materially different from the way human beings felt here, 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 or here. And we know in each case, 100% of those moves were fully retraced. And remember, in the 21 100-day, 200-day historical cases with the similar cross to January 17, 2019. In the average case, it took 169 calendar days to reach the subsequent new low or retest low, and the median time for the subsequent low or retest low was 81 calendar days, telling us if we followed a similar retracement path based on this cross here, the S&P 500 hypothetically could trade back down to 2332, a level not seen since early 2017, and hit that level hypothetically on April 8th of this year. And based on the average outcome, we could hit 2244, significantly below the December low, and hypothetically reaching that point on July 4th, 2019. Typically, it takes a long time to correct something like this. As the 2001 and January 25th looks remind us, it's extremely important that we maintain that patient, prudent, measured, and data-dependent approach as we head into next week. There's a reason why we cover both bullish and bearish cases. It enables us to maintain that important maximum flexibility, take it day by day, remain patient, and prevent ourselves from front-running the data or jumping the data-based gun. And it reminds us that forecasting is difficult at best. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.